In this video, we will discuss about support and resistance level, how support and resistance work and what is the importance of these levels. Now, first of all, what is support and resistance? Support is a price level where a downtrend can be expected to pass due to a concentration of demand. As the price of a security drops, demand for the shares increases, thus forming the support. Resistance is a price level where uptrend can be expected to pass due to a concentration of supply. As the price of a security rises, supply or profit booking for the share increases, thus forming the resistance. Now some example of support and resistance. We use the terms floor for support and ceiling for resistance. Continuing the house analogy, a security is how a rubber ball that bounces in a room will hit the floor is support, and then rebound off the ceiling is the resistance. A ball that continues to bounce between the floor and the ceiling is similar to a trading instrument that is experiencing price consolidation between support and resistance zone. Extra force or enthusiasm from either the bulls or bears is needed to break through the support or resistance. A support level will eventually become a resistance level when the price attempts to move back up, and conversely a resistance level will become a support level as the price temporarily falls back. Price charts allow traders and investors to visually identify areas of support and resistance, and they give clues regarding the significance of these price levels. How support and resistance works. Technical analysis use support and resistance levels to identify price points on a chart where the probabilities favor a pause or reversal for a prevailing trend. Market psychology plays a major role as traders and investors remember the past and react to changing conditions to anticipate future market movement. Once an area or zone of support or resistance has been identified, it provides valuable potential trade entry or exit points. This is because as the price reaches a point of support or resistance, it will do one of the two things: bounce back away from the support or resistance level, violate the price level and continue in its direction until it hits the next support or resistance level. What happens if support and resistance breaks? Support and resistance level are psychologically important levels where a lot of buyers and sellers are willing to trade the stock. When the support and resistance are broken, the market psychology shifts and new level of support and resistance are established. Importance for support and resistance zones. Number of touches. The more times the price tests a support or resistance area, the more significant the level becomes. When prices keep bouncing off a support or resistance level, more buyers and sellers notices and will base trading decision on these levels. Preceding price move. Support and resistance zone are likely to be more significant when they are preceded by steep advances or declines. For example, a fast, steep advance or uptrend will be met with more competition and enthusiasm, and may be halted by a more significant resistance level than a slow, steady advance. A slow advance may not attract as much attention. volume at certain price levels. The more buying and selling that has occurred at a particular price level, the stronger the support or resistance level is likely to be. When strong activity occurs under high volume and the price drops, a lot of selling will likely occur when price returns to that level. Since people are far more comfortable closing out a trade at the break-even point rather than at loss. Time. Support and resistance zone become more significant if the levels have been tested regularly over an extended period of time. Identified methods of reversal point. Number 1. DeMark or Williams method. Number 2. Gann 2-day swing methods. Number 3. Percentage method. Number 4. High volume method. DeMark or Williams method. In a low bar, for example, the analyst may look for two bars with higher lows directly on either side of the suspected trough bar. The number of bars on either side can be increased to boost the importance of the trough, but the number of troughs will be sacrificed. The higher the number of confirming lows necessary, the more important but less common the trough. Each of the two bar lows and highs is marked with an arrow. Point A is not a trough because it does not have at least two bars on either side of it with higher lows. Likewise, point B is not a peak. It does not have two bars on either side of it with lower highs. Is point C a trough? We do not know because we can't see if there are two bars to the right of the low to judge point C. Percentage method. Another method of identifying significant trough is by deciding beforehand how much the price should decline into and rally from the trough. A percentage is usually used using 1%. For example, anytime the price decline more than 1% makes a low, and then realize more than 1% would define a 1% trough. The larger the percentage used, the more important but less frequent the reversal point. Gann 2-day swing method. WD Gann swing method is similar to the DeMark or Williams method. Once the low bar is identified, the two following trading days are observed. If these 2 days have higher highs than the low bar is a support point. A resistance point is defined as any high bar during an uptrend that is followed by two successive bars with lower lows.